Next, Harbor Company acquired an interest in the common stock of I-Bar Corporation in an exchange of 15,000 cash that you paid and a computer equipment with a book value of 60 but a fair value 50. We don't take book value. When you are acquiring some shares in the company, you are giving 15,000 cash, okay, and you are also giving a computer equipment that is a market value of 50. So in fact, what you are paying a total of $65,000. This is the consideration being paid. This is the value of investment. As a result of this transaction, Harbor should record the investment at 65, not 15 plus 60, not 75, 65, because 15 is cash and 50 is the market value, fair market value the asset being given. So it's going to be 65. That will make C to be the correct option. Next, a material overstatement in the ending inventory was discovered. Whenever closing stock is overstated, a higher closing stock means your current assets would be overstated. A higher closing stock means your cost of goods sold will be understated, and a lower cost of goods sold means you will have a higher gross profit, a higher net profit, a higher level of retained earnings. This is the chain of things that move forward. So a material overstatement in the ending inventory was discovered after the end financial statements of the company were issued to the public. What effect did this error have on the year-end financial statements? Your closing stock would be overstated, which means either B or D, whereas your gross profit would also be overstated. That means either this or this. So the only combination that is in perfect harmony is B. Next, the concept industry is preparing its income statement for the year ended December 31st. In preparing this, the statement, the line item displayed before considering income tax effects. Before income tax, what you have? First, you have your gross profit. From this, you deduct your operating expenses. What you get is called the earning before interest and tax. From this, you deduct your interest. After that, you get your earning before tax. From this, you deduct your tax, and then you get your net income or net profit. So the question says earning before considering income tax. Before considering income tax. You're talking about earning before tax. Earning before tax effectively is your income from operations. Income from operation. This is earning before tax. This is the answer. Why not B? Income and loss from continuing operations. Please remember, income and loss from continuing operation, it is reported on after tax basis. Net income is always on after tax basis. Accumulated other comprehensive income, it is reported as a component of your statement of changes in equity. So B, C, D are incorrect. A is the right answer. You should have a good reason for selecting the correct one. Moss Company has determined its December 31st inventory on FIFO basis to be 950,000. Information pertaining to the inventory is given as follows: estimated selling price, cost of disposal, net profit margin, and the current replacement cost. Moss records losses that result from applying IFRS, lower of cost, or NRV. I'm sure you know, under IFRS, under the US GAAP, please remember, FIFO method of inventory valuation means that US GAAP and IFRS, they are on the same page. And what they say, you take cost on one side and you take NRV on the other side. Cost is given as 950. And what is NRV? NRV is the final selling price minus cost to sell minus cost to complete. This is all revision, you have done it. 965 less 25 gives you 940. IFRS and US GAAP tells us that under FIFO method, you need to compare cost with the NRV. Take the one that is lower. Since NRV is lower, this is going to be your new basis and you need to write off a loss of 10,000. So at December 31st, what should be the carrying value of the inventory? 940. And what would be the loss to be written off? 10,000. So that means 940. B is the answer. All of the following are captured on the balance sheet except Walalazim. All of these are on balance sheet except one of these. Property, plant and equipment, yes, it is on the balance sheet. Total debt owed within 12 months of the reporting date. that is the current liabilities, it is reported on the balance sheet. Amounts of profits retained in the business since inception of the business, that is the another name of called retained earning. Instead of writing retained earning, he has given you some mumbo jumbo. Amounts of profit retained in the business since inception, that is retained earning or profit and loss account balance or accumulated profit. All these are reported on the balance sheet. This is another name of current liability. So what is not shown on the balance sheet? Management expertise. Why? It's a non-monetary asset. Management competence, management commitment, management honesty, management expertise, management ability to solve problems. This is something we cannot monetize. We cannot express in monetary terms. It cannot be reported as an asset. Even it is an asset. Company benefits from this, but it cannot be reported because it doesn't have any monetary value attached to it. So that makes B to be the correct option. Allen Construction Company signed a $48 million contract on September 1st, year 1 with the city of Springfield to construct a tunnel under the Maple River. On that date, the estimated cost to complete the tunnel, which was to be completed by June 4th, was $36 million. This is the estimated cost. Allen's fiscal year ends on November 30th and the company recognizes revenue over time. Data regarding the contract on the tunnel on which construction began December 1st, year 1 are given below. What is required? Assume that the estimated cost to complete at the end of year 3 were $2 million rather than 10 as shown. We'll see. The loss recognized on the contract for the fiscal year ending November 30th, year 3. This is important. You need to find for year 3. That's why requirement should always be kept in mind what exactly I was supposed to do. So what you should do, first you need to find out how much gross profit we recognize in year 2. Look at this. In year 2, we incurred an actual cost of $12,000. $24,000 cost still needs to be incurred, which means cost to cost formula, we have incurred 12,000. In fact, this is 12 million. And 24 million more required, which means the total cost is going to be 12 plus 24, 36 million or 36,000, or write the complete word. So 12 million incurred so far, 24 million are to be incurred. So the total cost to complete, including the cost incurred, is 36 million. So 12 by 36 times 100, that means the level of completion is 33.333%. How much gross profit can we recognize? The contract price is 48 million and the total estimated cost at the end of year 2 is 36 million. So 48 less 36 multiply by 33%, 33.3, that's approximately 4 million. So this is the gross profit recognized in year 2. Now, in year 3, look at this, what is happening in year 3. In year 3, we have actually incurred $30 million total cost combined year 2 and 3, and we still need to incur not 10, we need to incur 20 million more. So 30 million has been incurred so far, 20 million is to be incurred by the end of year 3. The total cost is now 50 million. Compare this cost with the revenue. There is clearly a loss of $2 million overall on this project. There is a loss of $2 million which you must book in the year 3. Now the problem is, what about the profit we have previously recognized? So 2 million loss in year 3 plus the previous profit recognized must now also be reversed. There is a total loss of $6 million on this project. Right? So that would mean C is the answer. 2 million is the loss, but the recognized profit now needs to be reversed. During inflationary period, last in, first out inventory accounting will generally have what? Inflationary period means when the prices are increasing and we are using last in, first out. When prices are rising, we are charging latest higher prices out first. That means your cost of goods sold would be higher. Higher prices, latest prices, and the inflationary economy are being charged to production, so CGS is higher. Because of higher CGS, your gross profit would be lower, your net profit would be lower, your retained earnings would be lower. And on the other side, since older costs are being transferred to closing stock will have lower cost. Higher costs are being charged to CGS, last in, higher in is being charged to cost, and the lower costs are being transferred to closing stock. So this is the arrangement. Let us see what exactly do we need here. It says lower cost of goods sold. No, cost of goods sold is going to be higher. This is incorrect. Lower cost of goods sold and lower ending inventory is the second part is correct. Lower cost of goods sold, no, and higher ending inventory, wrong, lower ending inventory. Higher cost of goods sold, correct, and higher ending inventory, this is incorrect as well. Higher cost of goods sold, yes, and a lower ending inventory, yes. This combination is perfect. Paxton Company started offering a 3-year warranty on its products sold on and after June 1st, year 1. Paxton's actual sales for the year were 2.695 million. The total cost of warranty is expected to be 3% of sales. The actual warranty expenditure for the fiscal year ended 31st May year 2 were 31,500, labor 31,500 in labor and 9,100 in parts. The amount of warranty expense that should appear in Paxton's income statement for the fiscal year. I'm sure all of you know, when you book warranty expense, you take your sales and multiply it with percentage given. So 2.695 million multiplied by 3%, so it's going to be 80,850. The entry that you're going to make is going to be warranty expense debit, warranty liability credit, 80,850. The actual amount you paid for labor and actual amount you paid for parts, this is in fact debited to warranty liability. You're going to debit warranty liability with the sum of these two, 9,100 and 31,500. It is going to be, I believe, 40,600. So you're going to debit 40,600 warranty liability and credit parts or inventory by 9,100 and credit the cash or the wages payable to your workers. This is the entry made to recognize warranty expense, and this is the entry made to charge the actual warranty spending by debiting the warranty liability. This is very important. You need to know it well. I'm sure you do. So what is the warranty expense charge to the income statement? Warranty expense debit to income statement, warranty liability credit, 80,850. When actual warranty expense is being paid, we don't charge it to the income statement. In fact, we debit the warranty liability and credit whatever is being given, cash or parts, or maybe money paid to our workers, or maybe the new product. Maybe you are replacing the old product and giving a brand new product to your customer under the warranty. So that is D. Next, regarding disclosure of income taxes, including deferred taxes, what should we report? The benefits of operating losses carried forward are not considered a component of income tax expense. The loss carried forward and carried backward, it was included in your CMA textbook 2 or 3 years ago. Maybe the comprehensive version of your part 1 still has these carry forward and carry backward. So they are no longer a part of the textbook, technically not a part of your syllabus, not tested anymore. So this basically is irrelevant here. Shouldn't be here, by the way, because this loss carry forward and carry backward is not in the text. So what should be disclosed? The significant component of income tax expense attributable to the continuing operation for each year presented should be disclosed in the financial statement or the accompanying notes. Yes, the components of income taxes should be disclosed within the financial statements and also in the accompanying notes. This statement makes sense. The income tax expense attributable to the continuing operation includes taxes applicable to discontinued operation. Discontinued operation is treated separately. It should not include in the continuing operation. Current tax expense or benefit and deferred tax expense or benefit are not components of the period income tax expense. In fact, they are. Deferred tax expenses and income tax expenses current, they are both part of the current income tax charge to the income statement. I'm sure you would have done your taxes topic well and you would know. This A is totally irrelevant to be ignored. B is what makes full sense. Next. A stock option plan may or may not be intended to compensate employees for their work. Stock options as a compensation to employees. The compensation expense for the compensatory stock option plan should be recognized. We can give stock options or stocks to our workers in two ways. One, a stock option that is exercisable maybe after 10 or 15 years. And other, a stock option as a compensation as a part of your salary. Now the question says, if the stock is a compensatory element, or the stock is being given as a compensation, the compensation expense of compensatory stock option should be recognized. Very straightforward. This compensatory stock option should be recognized as an expense when the employee performs the service. It is linked or tied to the service. If you perform your work, you get that specific stock option. And in that case, when this option is given, it is considered as an expense in your income statement. In the period the stock is issued, no. When the service is performed. In the period the option is granted, no. When the service is performed. And it is not reported as an expense. In fact, it is reported as an expense. It is an expense because it is considered as a part of compensation of the workers.